Okay, everyone, let's go ahead and get started. Welcome to today's webinar. We're going to be discussing 2-1 buy down, discount points, and seller concessions. I mean, as the market continues to change, it is these old tried and true terms and definitions and strategies are coming back full circle again. So I guess a little bit of housekeeping for those of you who are already joined. We're going to get everybody else caught up as soon as they get on. Good afternoon, Tanya, to you as well. From a housekeeping standpoint, many of you know me from my continuing education courses. This is not a CE course. This is a 1-hour online workshop, so there's no CE credits. We are going to be covering I do offer those courses as well. So anyone who has interest in like our USDA CE classes, VA CE classes, please reach out and we'll let you know when those are getting on the schedule as well. So welcome everybody. Boy, today's an exciting topic. We are getting so many questions about this. And just a little bit of background about myself and the company for those of you who do not know. I mean, I entered the mortgage industry way back in 1998. So I guess that would classify me as a mortgage dinosaur. And I started Metroplex Mortgage in 2001. We are licensed in Tampa, or in Florida, Texas, Tennessee, and Alabama, with our corporate office in Tampa, branch offices in Sebring and Dallas, Texas as well. We're heavily known for our government loan expertise. With that, our USDA and VA lender approval allows us to do all those loans in office, in-house underwriting, which we are so well known for. And obviously work with FHA and conventional. So we're going to have some background on the mortgage programs as we start off here as well too. And that gives us with that high experience with FHA and conventional. We have deep dive and we do so much credit review that comes with the territory with these government loans. And that's where we're starting to see us separate from the pack with some of these lenders who may not have the experience. Additionally, I'm a licensed California attorney and attorney for the corporation. Hold a certified mortgage banker status. And above all, I love what I do. I love doing the presentations and I love giving as much of this real practical experience to you that we can. So let's do a quick overview of the programs. So we've got USDA, VA, FHA, and conventional. We're going to come back and revisit this slide as we go through the course. Okay, this is just a big picture. You're going to get some important links that come out afterwards, and this is going to be one of the slides. Okay, so if you want to take a screenshot, you can, but you're going to get this link. You can always ask us for any of these slides, and we can get these over to you as well too. So this is going to be a replay to this. So if there's something you don't miss, you're going to get an opportunity to have the replay available as well too. So USDA, VA, FHA, and conventional, probably familiar to everybody on the course. No down payment on USDA, no down payment on VA, 3.5% down for FHA, and conventional for primary residences is a 3% down minimum. Okay, can be possible. You can see down here the different costs associated with it. We're not going to go too far into this right now, but I mean, here's the differentiators between USDA, VA, FHA, and conventional. We are going to really dig into the seller concession component as we get towards the end of the course and illustrate the differences between those. And as a starting point, I wanted to just get some quick feedback from you. And for those of you who are not familiar, utilize the chat board for any communications. Any questions that come up, throw them on the chat board. I love questions because I love to apply everything we're talking about to the practicalities of what you do on a day-to-day basis. How can we help more home buyers get into homes? And I guess as a starting point too, well, let me ask you this question. What are you seeing out there in the market? Is there more seller flexibility from what you're seeing? Is there a little bit of seller mentality? Maybe they think they missed the boat with those higher prices when they could have sold, let's say 6 to 8 months ago compared to now. What are you seeing from the buyer mentality? And if you could please go ahead and put just some brief comments on the chat board. I'd love to hear what's going on because we have attendees today from a variety of states, variety of counties, areas, and every market is unique to its own, as you're well aware. What we're seeing is a lot of our USDA and VA buyers are getting bites at the apple. And what do I mean by that is these higher interest rates have caused sellers to be a little concerned and thus be more open to, instead of just saying cash or conventional, looking at all offers could be a good offer, which they should be as well too. So we're seeing a big push here recently, even in the last 60 days, of our USDA and VA buyers get their contracts accepted. And what we're also seeing is a lot of lender mortgage malpractice is what I call it. The mortgage malpractice is high because remember, I was back in the 07, 08 period where the whole financial crash, the Great Recession. I mean, I lived through that. I went through that, made it through it on the other side. And we're seeing, even though it's completely different, okay, back then we had too many homes for sale and not enough buyers. Now we still have an inventory shortage. We have sound mortgage programs. The qualifying process is very stringent and qualified buyers are getting mortgages and they're getting in the homes. So we have a completely different dynamic than before. So, but one of the items I'm seeing is because there's a reduction in mortgage volume, a lot of these lenders are really stretching. They don't know where their next deal is going to come from. We're seeing a lot of qualification letters similar to back in 07, 08. They were not worth the paper they're written on. It is more important for you now to understand who's providing the financing. Are they competent? Do they know what they're doing, especially on some of these unique programs, terms, and techniques? So be really, really careful out there. Yes, Cheryl, some think they missed a boat for not selling. I agree. We've heard that too. And that has helped us, some of our buyers, get offers, at least get their foot in the door with the offer. So here's our overview of the programs we're going to be dealing with today. All right, so USDA, let's start with some background facts on USDA, VA, FHA, just a quick overview to lay our foundation. So USDA single family guaranteed loan program, it's homes located in eligible rural areas. There are income limits, 30-year term fixed rates. There's never any prepayment penalties on the programs we're talking about today as well. And USDA is heavily known for its no down payment. And what we're also seeing is a big push for the buyers with a lot of the uncertainty in the economy, wanting to hold on for as much of their money as they can with USDA and VA. If they're eligible for those, then trying to really take advantage of those programs. So if you're, and I talk about this in my USDA and VA classes, I say, don't be scared, be aware. Know the programs, have enough comfort level with them so that you're not turning a buyer off who thinks you're trying to steer them one direction or the other. Very important with the feedback we're getting from the consumer. Karen mentioned seller willing to finance, price decrease in all areas, but not plummeted. Sellers not willing to reduce just yet, still hopeful. Buyers paying, converting from stock. You know what, Karen, you're right. All the above. I mean, we're seeing these in a variety of areas. I think you really hit the nail on the head. Sellers may not be willing to reduce. The prices are not plummeting. We're seeing some price flexibility. Some seller concessions get in there, a little bit of negotiating room, okay? Anna Maria asks, is it true that homes on a dirt road will not qualify for a USDA loan? That is not true. That is a myth. We're going to talk about quickly here, private versus, there are some private road guidelines to be aware of, especially in the rural areas that we serve. I mean, because that's that people come to us because we know how to navigate the rural areas. And it's a completely, as you all will know, it's a completely different animal. For some of these lenders that are not used to USDA, VA, what's a water test? Distances between the well, the water, the septic tank, drain field, those type of things. They don't know to ask those questions. And we're seeing a lot of mistakes from lenders that are just, they're in over their heads. They don't know how to navigate the rural areas. So the big one here, I want you guys to remember this down here at the bottom. With USDA, the financing is not based on the sales price, but it's based on the appraised value. So if it appraises for more, we can include more into the loan and finance costs in. We're going to be addressing this as we get to the very end. So remember, the financing is not based on the sales price, because if it appraises for more, we can increase our loan amount. Okay, so eligible property types. For all of our programs we're talking about today, it's going to be primary residences. unless it's, I mean, all the government loans, USDA, VA, FHA, conventional loans will allow the second homes or investment properties. But USDA is primary residence only. You have existing single family homes, condominiums require approval. We can work with our USDA construction loan with single family, manufactured, and modular homes. And for those of you joining us in Texas and Tennessee, USDA does allow existing manufactured home there under their pilot program they have. So if you are in Texas or Tennessee or other licensed states, we're able to work with existing manufactured homes. There are restrictions on that. So if you have that of interest, let me know and we can reach out afterwards. USDA also has very healthy income limits to work with. So what I mean by that is you have to fit at or below these income limits, and it goes by who's in the household. This is something as the market shifts, as the market transitions a little bit, and we're moving into a different season, a different cycle, so to say. We're seeing lenders make big mistakes on USDA and VA in particular because there's more nuances, there's more requirements, there's more steps involved. So not the more or less the mainstream conventional or FHA, I like to call it. But USDA has income limits where we have to look at everyone in the household, everyone that is a member of the household, children, grandma, grandpa, parents, whoever may be, brothers, sisters. And based on the household size, so for a 1 to 4 person household, I brought up Florida for this. Okay, obviously it's going to be different depending on what county you're in and state. So for a 1 to 4 person household, so let's say you had mom, dad, son, daughter, 103.5 is our limit. And then if you, let's say you added grandma and grandpa into that mix, that puts us up to a 6 person household, then it can be up to 136,600. This is a very unique part of the loan program, and it's something that has to be analyzed in the very beginning without any question. This is a non-negotiable part of USDA. The property's got to be in an eligible area, and you've got to be within income limits for your family household size. Now, I want to throw a couple of these slides in there just to show how we're helping get people into homes. As the market shifts, as different properties are opening up, in our Florida market, we have experienced many of the roofs that were put on 05, 06, 07 in that time frame when those last round of hurricanes came through. You've started to see the need for new roofs to come on, repairs to roofs. We have in our USDA program, we're able to finance these type of repairs after closing. So we can build them into the loan amount. We can build them into an escrow account, have it sitting there so that the repairs can be done after closing. Huge, huge negotiating point when you're working with sellers. It can be very advantageous for them to be able to walk away from the property. Instead of paying 10, 15, 20,000 up front, they can hold that back. They can reduce the price. The buyer can finance it into the loan. The key takeaway is we can do a variety of repairs. We have many of these we're working on as I'm talking right now, where we're setting up estimates, invoices for the work to be done post-closing. Now, depending on the amount of the repairs, you can see here in that first bullet point, if it exceeds 10,000, then we're looking at, we need a contractor involved, we need a contractor involved if it exceeds 10,000. If it's 10 or below, then we can look at, we can have like the AC installation company, the flooring company could be options. Maybe it's just a roofing company for a smaller amount, what it may be. So we really analyze it case by case based on the total amount that will be deposited into the escrow account to hold the money. So just like the title says, this is for repairs that are then deposited into an escrow account and held back after closing for the work to be done. Under this feature, the repairs cannot affect livability, safety, or health of the occupant. So technically, they must be able to be done while they're living in the home after closing. If it's a situation where we need a contractor involved, we're going to get that contractor signed by the borrower and the contractor for the work to be done. We're going to hold back the money on their closing disclosure, and repairs be completed within 90 days. that can be extended depending on the circumstances. Once the repair work is done, the appraiser will go back out to the home and certify the work's been done. And then that's when we give the green light to release the funds. Now, probably a lot of us on the call have had situations where we have repairs done beforehand. We've got a separate checklist we do for that, okay? For the repair work done afterwards, some of the benefits are the contractor knows, or the installation company, the vendor knows the money is there after closing, okay? If we're doing repair work beforehand, we get all the way through getting our USDA commitment finalized. Really, at the last stage, then we have the repair work done before closing. So we have different ways we can maneuver repairs. So all those times where I hear, well, Sean, the property won't qualify for USDA because. I need to know because of what? Because that answer tells me how I can manage the repair process. So don't automatically think it's a no-go because of this, or that. Let's talk through the scenario, because everyone is case by case, just like a fingerprint. Everything is case by case on these repair issues. And more times, often than not, we're able to get a solution put together. So as we're trying to expand our housing options for buyers, don't automatically assume it's not going to work. We might be able to have a remedy and fix the scenario. Also, I mentioned this a little bit in the beginning. We are one of the very few lenders in the country working with this USDA construction to permanent financing. I mean, USDA actually gave us a shout out recently on the work we do under the USDA manufactured home construction to permanent loan. So it's really great to be mentioned in it. I'm going to pull up the article. I'm going to show you guys here. We're so proud of this, because helping manufactured home housing, there are many lenders. It's when you get into the rural areas, you're looking for, there's so many options come up. And here is what they actually gave us a shout out. This is from USDA in their home ownership month. They put a little blurb in there about how we'd help the single mother buy a new manufactured home with a construction loan with draws to set up the home available after closing. So we were really excited about this. And it's something that can help expand home ownership, where we're working with approved dealers or approved builders if it might be a single family residence, modular homes as well too. People looking to expand where they're living at, looking at different options. We're able to work with single wide manufactured homes and double wide manufactured homes, as well as obviously site built homes, single family residences, or modular homes. So really an exciting product to have available to help expand what you're available, what properties you can show your buyers. So from my standpoint, if we can go through and give you all available options, we can talk about new construction. We can talk about repair options, USDA standard traditional loans, existing manufactured homes for those pilot program states, Tennessee and Texas being two of them. We're really giving buyers a wide variety of affordability. Now let's quickly get to the VA, give you a background on that. So we're a VA approved lender, which means we're doing the underwriting, we're doing the approving, just like our USDA product. We're manufacturing and doing all those loan processing, underwriting, approving right within our office. So VA does guarantee a portion of the loan. It allows for 100% financing, so no down payment. We can look at purchases or refinances, obviously in our market, primarily purchases. Highly flexible credit qualifying. It has to be an eligible service member. Manufactured homes. This is one of the most flexible programs for existing manufactured homes, both single wide and double wide manufactured homes. Really a phenomenal program for that purpose, not on its own, but just as another feature that works within the VA qualifying process. And here's a quick snippet of all the various individuals who could be eligible for a VA loan. The era, like the you see from left to right, the dates, the time required. If you can be surviving spouses as well too. So we have a high flexibility with VA. So if you get that USDA and VA buyer, they might be qualified for both. Those are such beautiful programs to get eligibility with. Working with, just having an opportunity. If anybody on our call or listening to replay does have a military experience, I want to thank you from our whole team for your service to our country. It's such an honor to be able to work with our veterans on a daily basis, help them navigate the process, dispel myths, work with them on their credit qualifying, and help them achieve home ownership. It's really a rewarding part of the process. Sue mentioned, I thought VA excluded manufactured homes. That may be a lender overlay. If you ever hear the word lender overlay, that is referring to a lender may have a guideline above and beyond what is required by the agency. So VA would be the agency. So VA does permit both double wide and single wide manufactured homes. So it's something we work with regularly in our rural areas. So it's a great option. It's there's a lot of confusion with this, and it's very underutilized. So it is a great feature for that as well too. And as well, I mean, you got FHA, primary residence is mentioned. With FHA, they do allow non-occupying co-borrowers or co-signers. Okay, you could have a mother, a father, uncle, and you could have that relative join in on the qualifying process to help expand the budget. Obviously, everybody's got to qualify for that, but that's a nice feature where USDA does not permit that. VA would not permit a non-occupying cosigner. And it's not only for just first-time homebuyers. So USDA, FHA, and VA, they're not just first-time homebuyer programs. They can continue for someone sold their home, they're looking to buy again. This secondary, they don't have to just be a first-time homebuyer. Monthly mortgage insurance premiums. This is some of the, when you're comparing programs as far as cost, FHA's got some of the higher costs. So that would be a drawback. Okay. But if FHA is what's on the table, it offers some very affordable financing as well. And as well, let's dive into conventional before we kind of transition to the buy down. Because I really wanted you to have a nice foundation of where we're at in the mortgage cycle, because everything we're going to be talking about the next portion of the course is really going to be layering into that with the buy downs, the discount points, and the seller concessions. So conventional financing, whenever you hear conventional, those are going to be governed by Fannie Mae and Freddie Mac requirements. So maximum financing, you could look at 3% down. Customarily look at 3 to 5% down options for primary residences, 10% down for second homes or vacation properties, and then 20% down minimum for investment properties. So mortgage insurance, if you're putting less than 20%, will vary based on credit score, loan terms, whatnot. And you can also work with manufactured homes under this as well too. So another really, really strong option under the conventional market. And here's our private road requirements. Okay, I know we had the question earlier. So let's jump into, I believe that's Anna Marie asked a question on that, the dirt roads. So private road requirements. So remember, it's not public versus private. I mean, I had I was sponsoring one of the county realtor membership luncheons, and I was able to speak before the local county roads and bridges official came up. And it was really a great segue because I love this topic. This is another, I mean, this brings out the mortgage nerd in me more than anything. Private road requirements. And yes, you can laugh at that. I have no problem calling myself that. Mortgage dinosaur, mortgage nerd, mortgage mechanic, whatever it may be, you can call me that because it's all the above. So, but this is something where I see a lot of mistakes, a lot of lender mistakes still today, where I see underwriter emails come through and it says, so this program won't finance on a dirt road. Dirt road is not, I challenge anyone to find that anywhere, unless it's some online obscure blog that's just talking. Guidelines do not classify versus dirt. They classify versus public or private. So you need to know if it's a public road. In some counties, you have a public right-of-way. It may be unpaved. That is still considered a public road. So, but for those truly private roads, as determined by the county, let's say, okay, for those truly private roads, dirt, gravel, I mean, notwithstanding dirt, gravel, paved, whatever it may be, because you could have paved roads that are private within a community, Okay, so we got to figure on, if you have any confusion, you're going to see a listing. You got a buyer, you're taking on a listing, whatever it may be. If you're not certain, contact the county roads and bridges to get more details. Okay, and then let us know the results, or if there's any questions you have, because this is something where this is another one of those rural area type of characteristics that you just need to be aware of, where a lot of these lenders, big lenders and small lenders alike, a lot of the big lenders are out of touch. A lot of the small lenders just don't have the experience to tie together and understand what to look, or they're just too overrun because they're trying to answer the phone, they're trying to send an email, they just don't have the infrastructure to know the guidelines and research properly. So you see it right there, USDA, FHA, and Freddie Mac. Private road maintenance agreements not required, but you're going to need to show permanently recorded easements for ingress and egress to the property. VA and Fannie Mae require private road maintenance agreement. VA does offer the ability to obtain a waiver once the appraisal is back of this requirement. Okay, so that's the overview of the private road requirements. Remember, the big thing is not dirt or paved or gravel. It is public versus private, which triggers that analysis. Okay, so now let's jump into what is a 2-1 buy down. So hopefully everyone got a good foundation. I wanted just to briefly get through that because it was important, just as a refresher. I'm getting a lot of questions as we're coming out of that cash conventional mindset. A lot of refresher questions from realtors that said, Sean, we need to be refreshed on this information. So we're going to be, as we do every year, we're going to have a big series of CE webinars, both CE webinars and these online workshops as we go into next year. So please just stay up to date with this, because we're going to be really going into USDA, VA heavily as we get into next year as well too. Okay, 2-1 buy down. What is it? Okay. Let me give you the technical term here, and then we're going to show some illustrations and some screenshots so you can visually see it, which always helps from my standpoint on learning. I'll read it to you right here. First bullet point: a temporary subsidy buy down is a way to use excess cash to temporarily reduce the borrower's mortgage payment. Seller funded, it could be builder funded as well too. We're not working with buyer funded buy downs right now, but that could be an option depending on your lender. The funds are then taken, let's say from the seller or the builder at closing, and then deposited into an account similar to your escrow account. And that's going to be held by the mortgage servicer. The funds taken must match the buy down, because remember, the buyer is going to have a lower payment for the first 12 months, let's say. And there needs to be money set aside in a separate account to make up the difference. Then the next 12 months. So when you hear the word 2-1 buy down, that means the amount of time, the initial 2 years is where you're going to have the lower payments. So in this case, it steps up after 1 year. So you have a lower payment the first 12 months. It gradually goes up the next 12 months. Then it goes up to their full payment after that. So just like I said, the borrower's monthly mortgage payment during this time is supplemented with the subsidy funds for the term of the buy down. So 12 months, 24 months. Remember, this is very important. The last bullet point, I'll read it to you. Temporary buy downs do not alter the borrower's contractual obligation due on the note, but temporarily reduce the amount the borrower will pay each month for the term of the buy down. So the borrower will close at 6.5%. Okay, their note, the document titled the note will reflect 6.5% on it. There will be a side agreement, so to say, a side agreement where that's buy down account is set up for the funds to come from to make up the difference. Okay. So this is not something brand new. This has been around for a long, long time. But now it's gaining more traction because of the rapidly rising rate environment we've been in. Rates have they've leveled off and they've come back some, but don't assume that's a trend. I know the Federal Reserve is going to be having their announcement with their expectation to raise rates again this month. And I don't know how soon they plan on slowing that down, that whole pace. So just be very, very aware. I mean, this is terms out there. Is this going to be for every buyer? No. It's not going to be. Is it something just I want you to be aware of? Yes. Let's walk through some of the highlights. So the interest rate temporarily reduced by no more than 2 percentage points in this example. There are 3-2-1 buy downs as well, too, available. Primary residences and purchase transactions only, single family residences, condos, conventional FHA, VA, and USDA. Right now, we're working with this on VA and USDA, and we're going to be opening up conventional here at the beginning of the year is the goal. And then you can look at 12, 24 months. There can be 36-month options available as well, too. Here are some of the benefits. It can provide that immediate affordability. Let's say there's already the conversation happening is when rates come back around, being able to look at a refinance to increase that affordability. This buy down will, in essence, give you that. You'll have that planned out. You'll have that game plan in place. Look, here's my payments for this 12 months. Here's it for the next 12 months. And then I go up to the full payment. It is, if you see the second bullet point, I think this really helps explain this. Predetermined structure allows borrower to plan for predictable payment increases. So this is not an adjustable rate. Okay, we have a fixed 30-year term. This could mean this is not an adjustable rate, just to be clear. I get that question a lot. This is a 30-year fixed rate where the payment is being bought down through that lower rate for the first 12 months, the next 24 in a 2-1 buy down structure. If there's any money left over after it's done, that can be used to be applied towards a principal reduction. There is going to be a temporary buy down agreement between, let's say, the seller and the buyer, and where all those terms are going to be disclosed, and then we would have that in the closing package as well too. You may, if you find companies that are willing to do this, by all means, just do your research on them. But here's commonly ineligible program types: borrower funded, like we talked about, investment properties, multi-unit manufactured homes, refinances, adjustable rates, or annual adjustments other than 1%, which exceed that 1%. Let me give you a screenshot here of how this would look. It's not going to be something you're doing on every transaction. It's going to be for particular buyers. Maybe they know their income is increasing, however it may be. I mean, this is something that there's an education process with it for buyers. It's not for every seller to fund. Sellers have to understand how this applies as well too, and what this actually is. But my main goal was maybe you may never need this or use this at all. I just want you to know what it actually is. All right, so you can see here, let's look in the top grid. We have our loan amount over here. Here's our note rate, the 6.5, 30-year term. Okay, you can see they're buying the rate down the first 12 months to 4.5. Here is our note payment. Here's our payment, the principal and interest payment that they're obligated to pay. Here's what the borrower pays the first 12 months. Here's the rest of that, their payment that's owed, because that comes from the buy down. Okay, so that comes from the buy down itself. You can see where, hopefully this graph illustrates it nice. All right, then you have the second year, the next 12 months, you're looking at, you see the payment step up right here. Okay, and then on the third, as you go into the third 30 month, the 24 to 36, and that after you get above the 24 months, and you're looking in then you see your note rate step up to the 6.5%. There's the monthly buy down right there, and there is the amount of funds left over is there. So is there any questions? Does that help? That visual help a little more? And the one below this is just a 1 year. So it doesn't always have to be a 2-1 buy down where it goes 2 years and 1%. It can also be a 1 year buy down. And what questions do you have right now? As we're going to move on to the next topic here, we can always come back and revisit this. You're welcome, Nathan. Yes, you're correct, Tessa. It does have to be approved by the lender. So make sure not all lenders work with this. Not all lenders do on all programs. So just make sure you do get this approved up front. They're going to have the agreements. They're going to have the templates. Let them guide the transaction from there. All right, discount points. So a discount point, let's say you do 1%, 2%, 1.5 points, a half a point. So the borrower is going to pay a percentage of the loan. So 1% of 400,000 is 4,000. Okay. And then that's going to decrease the interest rate, which will then that rate stays the same. Unlike a temporary buy down where you're only going to have, let's say that it could be 36 months, 24, 12 months, and then you go up to the note rate. Your discount point will buy that rate down permanently, and that cost may be borne by either the seller or the buyer. So you can see here these 4 bullet points. Unlike a temporary buy down, as I just mentioned, discount points offer that permanent rate reduction. But that rate reduction could be minimal compared to that steep discount you get on the temporary buy down with the lower rate. You could be going down 2%. You could, in some cases, be 3% below the actual note rate with that reduced payment. We're seeing a lot of builders get flexible with these options because they're scrambling for buyers and that affordability too. When you're looking at discount points, you really have to be aware of the cost. There has to be a cost analysis versus the recoupment time. For example, when we're talking with families, talking with home buyers, how long what's your plan to be in this home? Are you going to be selling? Are you looking to refinance down the road? Because you have to, I know no one can say for certainty when that day may come. They may be able to, they may not. You have to be able to analyze how much cost am I paying for the benefit if I am planning to do this event down the road. Okay. So there is a cost analysis with the discount points as well too, that we want to make sure they're going to recoup that, because if it is a permanent rate reduction, for how long is that into the future, that rate reduction going to be? If they're going to be paying for something and then selling the home in 12 to 24 months, maybe that the higher rate could be better and more cost effective. And you may combine, I don't want to blow anyone's mind on this, but you may combine discount points and buy downs on the same transaction. You could buy down, you could have a discount point that instead of that 6.5% rate, go back to it. Instead of the 6.5% rate, maybe you bought that down to 6%, and then your buy down was applied on that. So instead of your note rate right here being 6%, maybe use the discount point to buy that down to 6%. And then you also had a 2-1 buy down. So it'd be instead of 5.5, it'd be 5. Instead of 4.5, it'd be 4. So you could buy down that. You could use a discount point on this as well too. I don't know if that's going to happen. I mean, I'm just telling you it could be possible. Okay. And that's why I want to do this webinar as well, because just from a terminology standpoint, you can come out of this and you know what it is. When you're talking with buyers, you don't have to be the one giving all the nitty gritty. That's what we would do. Okay. You're aware of it. You understand it's out there. You've taken an online workshop about it. You have references. We have resources. You have my team in the office. Okay. So you're not on an island after this shuts down. You need help. That's what we're here for. Imagine that if you called a company and they actually answered the phone or called you back. Wouldn't it be nice if everyone did that? That's what, no matter what era it is in the mortgage industry, those tried and true customer service methods, I mean, it all stays the same. So let's transition to seller concessions, okay? Or also referred to as interested party contributions. You may call it seller contributions, whatever. I mean, these are the common, so seller concessions or interested party contributions could be the technical term. So with conventional loans, when you put less than 10% down, you are capped at 3% of the sales price. 10% down or greater, that increases to 6%. Investment properties are capped at 2% of the sales price. And the reason I bring this up is, let's say you got a 5% down first-time home buyer. A lot of agents confuse that with USDA and FHA, which allows 6%. And then you've got to go back and rework the contract. So for conventional loans, not until you get 10% down or greater does that open up higher concessions. What are you seeing out there with concession flexibility right now? Are sellers being more open to it? We're seeing it on contracts getting accepted. We're seeing concessions sellers agreeing to concessions. So that kind of flexibility is really opening a door for at least a negotiation process. But let me get your feedback. What are you seeing on the concession front in the variety of markets that are on the call right now? If you could throw some comments on the chat board while I continue to move on, that would be great, because I would love to hear your feedback personally from that. Now, on the government side, FHA, this is a little more straightforward for FHA and USDA. They're both 6% of the sales price. It's easier to remember, okay, regardless how much you put down. VA has a unique feature where they allow a 4% cap towards prepaid items, but there's no limit on closing cost. Let me give you an idea. I mean, prepaid items could be insurance premiums, escrow setup, prepaid interest. Closing costs could be recording fees. It could be title company costs, state charges, whatever. I mean, those are the type of things with VA for prepaids and closing costs. Okay, I was actually teaching a VA class one time, and there was a sponsor before. It was a mortgage company that was doing the sponsorship of my class I was teaching, and I had to nicely correct the sponsor, because they said VA has a 4% cap, which wasn't true. Okay, so we're going to dive into that. That's our overview. So Fannie Mae, here's our Fannie Mae definition. Interest party contributions are costs that are normally responsibility of the property purchaser and paid directly or indirectly by someone else. So that could be a seller, builder, developer, real estate agent, broker, etc. So Fannie Mae refers to it as interested party contributions, and Fannie Mae would obviously be conventional, so it would follow this criteria right there. All right, so that was Fannie Mae conventional. FHA also refers to the term interested party contributions. So obviously sellers, real estate agents, builders, developers, mortgagees, third-party originators, or other parties with an interest. So if you jump down here to the third, this section here you see that 6% of the sales price verbiage that we talked about. And that can be used toward the borrower's origination fees, other closing costs, prepaid items, and discount points. There's our terminology again. Here's our discount point terminology right there. We talked about the 6% limit includes temporary interest rate buy down. So here's our terminology again. So a temporary interest rate buy down, if the seller is funding that, if the seller is paying for discount points, all that has to fit within that 6%. Okay, so going back to Laura's question earlier about the 10,000, could they have a set amount? It's got to make sure you fit whatever the amount that's agreed to. The approved amount has to be within what the allowable limit is. Okay. So 6% would have to include any paid closing costs, any buy downs, any paid discount points, prepaid items. That's going to be, that's our limit for those interested party contributions. Like similar with looking at the, let's jump over to the next slide here. This is USDA. Here's our definition where they says are right there in the definition, 6% of the sales price. And USDA further clarifies that in the second paragraph, seller contributions cannot be used to pay an applicant's personal debt or as an inducement to purchase by including movable articles of personal property such as furniture, cars, boats, electronic equipment, etc. And does not include household appliances that are typically part of the purchase transaction. So here is an example on USDA. Remember I mentioned at the very beginning, USDA permits financing up to the appraised value. This is an example I just wanted to show to help illustrate that. So we got a $380,000 purchase price. We got a home that appraised for $400,000. Okay, so we got $20,000, kind of we're in the money, we're above our purchase price. Maybe there's seller, there's roof concerns, maybe there's some type of other escrows that we need to look at. So as you can see there with the second bullet point, buyer we have room there. We have 20,000 over. Buyer that 6% of the sales price could be used for an interest rate buy down. The buyer could take our $20,000 difference and increase the loan amount to finance in repairs. The buyer could finance in roof repair or also closing costs too. So we can, when we have with USDA's a different animal, because we have that ability to increase the loan amount, I can really make it flexible with what we can do with what the borrower includes with the loan versus what the seller may pay for. We could incorporate a temporary buy down with the seller concessions. The buyer couldn't pay for the buy down through their loan, mind you, but they could pay for their own closing costs by increasing their loan. We could fund a temporary buy down with any concessions from the seller within that 6%. So really a highly flexible option. We can do, let's say, those roof repairs, that escrow holdback. If we're doing new construction, I could build maybe a payment reserve in there or an interest reserve. I talk about those in depth on our construction class. So really, really flexible with what we can do. So that's USDA seller concessions. And now VA has a different criteria. So I guess if anything, don't get overwhelmed. This is very minutia in the detail, okay? But this is where the devil is in the details, as the saying goes. When we're putting together financing right now, it is all about deal structuring. How are we going to make it work? What's plan B if plan A is not going to work? Really diving into that experience where how do we make loans work? And as we're wrapping up here with our VA definition, you can see here, let me jump down to the bullet points. These are all in the VA handbook. VA, a seller concession, refers to, also includes permanent interest rate buy downs. I've got that bolded there. Temporary interest rate buy downs. And VA also allows the payoff of credit balances or judgments. So what many don't know is within that 4% cap. Now remember, with VA, they have a 4% cap on those prepaid items. They don't include that. That doesn't count towards closing cost. So for example, the closing cost could be those recording fees, title insurance, loan costs, those type of things. But within that 4% cap, we can include these items up here. I can actually have a seller pay off a veteran's debt at closing. That can help their debt ratios. They could pay off a remaining car balance. They could pay off a credit card balance. They could pay off a student loan balance if it fits within that 4% cap. I've had that feature save loans before. VA is such a powerful, powerful tool. Okay. No other program allows you to have the seller pay off a veteran's debt at closing. It's unbelievable how much you can really maneuver under, just USDA and VA by themselves because of all the flexibility, the various features we spoke about. So on that example here, we had a $400,000 sales price. You could go up to 4%. You could use that to fund a temporary buy down, pay off debt. You could also use additional funds to pay towards buyers' closing costs above that. Remember, you have closing costs and prepaid items. So you could look at prepaid items as one section, closing costs is another. All that combined would be your total settlement charges. And what I'm doing is I'm going to provide you links with these after you get some important links that go out. And then if you have anyone that you need to recommend, anyone, the best way we found out over all these years. Thank you, Gloria. Thank you so much. The best way to refer a buyer is if you can just get their contact information, permission to share that with us, then I have the resources on our team to start following up. So really just call, text, or email with their contact information. I've got my details on the slide right there. And then we will start to follow up. Just give permission for us to call. Then we take the guesswork out of it and we'll let you know if they are following through or not. Okay, that's the best way. If not, let us know if they plan on calling so we can at least be on the lookout and help keep them accountable. And let's say we tie everything together. I want to do a visual walkthrough of the process. We create the successful referral. We start the foundation. We lay that foundation. We get in touch with the buyer. We make contact. We start building out their profile. We get them qualified. We could talk about 2-1 buy downs, seller concessions, discount points, affordability. We talk really heavily about monthly payment, budget, household expenses. Look at that. Get them out with you looking for a home. We're nailing down the qualifications in the office. You get a sales contract. We begin this transition right into our sales contract to loan application status. Get the appraisal ordered. This is something that has really been top of mind forever on my team in my office. We're getting our loan paperwork back, getting the appraisal ordered ASAP. So we can get that appraisal started and get that appraiser assigned. Getting title and survey, doing our updates on processing and underwriting, and moving to the closing day. So we're really able to expedite and shorten our closing dates right now. And really, because of our systems and processes and checklists that we've built out over all these years, we know exactly what to do, when to do it, and where we can save time on a transaction. I know we got a few questions, but before everyone signs off, I wanted to thank everyone for their time today. I hope there was a ton of information in 60 minutes. We slammed through so much content, and it runs the risk of information overload. I get it, but I want to get as much out to you as I can. I'm always available for follow-up calls, office presentations. Please let me know if that's something you want, some additional training for your team, your staff. Well, I appreciate everyone on this and the constant feedback we're getting. We're helping buyers get into homes and the teamwork we put together to move everyone in to the next step on the home ownership ladder. It's call, text, or email. We're here to support. We're here to serve. And we're going to help get these buyers qualified and separate fact from fiction. And we're looking forward to working with you on the next transaction and talking to that next home buyer. Have a great rest of the day, everyone.